Hi, I'm Michael Correa, and this is Psych Exam Review. In this video, we're going to look at another potential error in our decision making, and this is the sunk cost fallacy. So, the sunk cost fallacy refers to when we make present decisions based on previous investments. So, for instance, a gambler who's been losing money starts making increasingly risky bets. They bet more and more in hopes that they can make up for those past losses. And now the reason that this is a fallacy is that these present odds of winning are not influenced by the previous losses. They don't know that you've already lost a bunch of money on this game. And so it's a fallacy to let those influence your decision making. We also see this with speculative investors who've lost money for themselves or for clients, and so they start making riskier and riskier investments. And they actually start making investments that they would otherwise never make, right? Things that just are not good investments. They start making them in hopes that one of them will pay off and it will make up for all those previous losses. And again, this is a fallacy because those previous losses don't have any influence on the present investments. So the important point here is that this becomes a fallacy when those past investments are not relevant. Right? And that's most obviously the case when we look at things like gambling or making a new investment. Right? Because the blackjack table doesn't know whether you've won or lost in the past. In the same way, investing in a new company isn't going to be influenced by your previous successes or losses. Okay, so there are some situations where we allow previous investments to influence our present decision making, but it's probably not considered a fallacy. And the reason for that is those previous investments are actually relevant to the present decision making. So for instance, if you're thinking about abandoning a relationship or quitting your job, these are situations where you've made some pretty substantial previous investments. Let's say you've been in a relationship for the past 5 years, and so you probably want that to influence your present decision making, right? You shouldn't just throw that relationship away for no good reason, right? Because you know that you don't get to start 5 years into the next relationship. You have to start all over again. And so you're going to have to reinvest a lot of time and effort into a new relationship, and you've already invested that in this current relationship. So maybe you should be careful in how readily you abandon it. Similarly, if you're thinking about quitting your job because of, some minor annoyance, right? Maybe you think about just quitting your job on a whim, saying, that's it, I'm out of here. Well, if you think about the previous investments that you've made in this job, maybe it doesn't make sense to do that, right? Because if you quit your job, now you have to start over somewhere else. You have to meet new people, learn how to work with them, sort of get a feel for the new culture in this new work environment, and that's going to take a lot of time and effort. And maybe you've already invested that time and effort into your present job, and maybe you should just view this as a minor annoyance, right? Rather than a reason to quit your job. Okay, so why do we make this sunk cost fallacy? Well, some research by Tversky and Kahneman suggests one possible explanation for why this happens. So what Tversky and Kahneman did was they asked participants a question. I'll read it to you here. Imagine that you have decided to see a play where admission is $10 per ticket. As you enter the theater, you discover that you've lost a $10 bill. Would you still pay $10 for a ticket to the play? So you can think about what you would do, and I'll tell you that 88% of participants in this study said they would still buy a ticket. It's a shame I lost $10, but I'm at the theater, I want to see the show, haven't bought a ticket yet, so I need to buy a ticket. Now, what Tversky and Kahneman also did was they did another variation of this question, and they asked some other participants. Imagine that you've decided to see a play and paid the admission price of $10 per ticket. As you enter the theater, you discover that you've lost the ticket. The seat was not marked, and the ticket cannot be recovered. Would you pay $10 for another ticket? Now, in this case, only 46% of the participants said that they would buy another ticket. But it's really the same thing as the first situation, right? I mean, you had something worth $10, and then you lost it, and then you wanted to see a show, right? It shouldn't matter that the $10 thing that you lost was in the form of a bill or a ticket. It's $10 either way. So why are people's answers so different? Well, what Tversky and Kahneman suggested is it's because people don't think rationally. They don't keep a single mental account of all of their costs. Instead, they keep separate little accounts for the costs of different things. And so in the first situation, people lose $10, but they when they think about their theater cost, it's not relevant. You know, it's $10, but it wasn't part of the cost of seeing the show. So it doesn't count. And so I haven't paid anything to see the show yet, so of course I'll pay $10 to see the show. That's what it costs. But in the second situation, what happens is when they lose a ticket, now they start counting it in this mental account for how much does it cost to go to the theater. And so now they look at this theater account and it's already at minus 10. It's like, it's already cost me $10 to see the show. I'm not going to pay another $10. I mean, I'm not going to pay $20 to see a $10 show. And so in this case, because of this separate mental accounting, they decide that it's too expensive to buy 2 tickets for the same show and they don't want to buy another ticket. Now, we can think about how this relates back to our sunk cost fallacy, and that if people kept a purely rational single account, they might not be as prone to making this error. But what happens is they start separating the costs of things into separate accounts, and they start thinking about how much has it cost me at this blackjack table? How much am I down here? You know, geez, I'm down $2,000. That's really bad. I can't let my blackjack account sit at minus 2,000. You know, I need to win at blackjack. I need to make up for that. Rather than thinking of a single sort of rational approach, which would be, you know, I'm down $2,000, I probably shouldn't start making larger and larger bets at the blackjack table. That's not very wise. But instead, they're looking just at that single account and saying, I can't leave with my blackjack account at minus 2,000. I need to do something to get that back up. And the only thing to do to get that back up is to keep playing blackjack and hope that you win. Right? So this gives us a little bit of insight into why this sunk cost fallacy occurs. I hope you found this helpful. If so, please like the video and subscribe to the channel for more. Thanks for watching.